JBlog 2010, January 31st. Last week was definitely quite exciting for bears like me. Um, Suddenly the bulls are running scared. Looking at Market Watch here, suddenly it's all filled with bad news. Mortgage bubble warning. Too soon to save, recovery will last. Stumbling into February. And of course we have our little Dow chart here for Friday, which looked pretty sad. And then currently we have Japanese shares lower as trading firms retreat, South Korea down, blah 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 blah. Very interesting stuff. The TED spread hasn't done anything. TED spread is still hovering around, what is it now, at 18, 17, 18. So interbank fear is definitely not running very high at this point. Banks are fearless. Glad to hear. Looking at a 9-month chart of the Dow Jones Industrial Average, the current correction here um, definitely does not look as scary as all the bad news would make you believe. Now, obviously, I believe the bad news is still understating the real problem that is out there. But from a stock point of view, it is definitely no worse than what we had back in June and July. And this could run a little bit further. It is showing as quite oversold at this point, so there could technically be a rebound. And then basically the question is what happens after this rebound. So let's say there's a rebound on Tuesday, because that's usually what happens, is things happen on Tuesdays. And then we could have a little bounce, and then the question is it going to go to a higher high? Here we had a little bounce, then it went to a lower low, and then it just kept on going. This was the big disappointment for most people, including me. Um, let's see if we have a repeat of that. Basically depends on how much liquidity the Fed will release into the market. Some important things that have happened. Let's switch to a 3-month chart here just to look at this. We did break a long-term trend line quite a ways back in December. Then there's a second trend line. Let me just switch back here. So this was the long-term trend line that was going from March. Then I drew another trend line that started basically in July, August, and that was touched several times. That was violated. Now we'll blow it up again. That was violated here this last week, actually on Friday, first time. So I drew a support line because now that we've basically penetrated all of the trend lines, we're into support. And support was also broken on Friday. On Thursday a little bit, on Friday a definitive break of trend line to the downside. Another one that I'd been trading short for a while and that turned profitable last week is Apple. Apple is one of those interesting, again, here's the first trend line that I drew that was broken in November. Then I drew a secondary trend line that was broken last week, so I drew a third trend line, a fourth trend line, and then basically now we are at support. At support being the one here, 190, roughly 190 level. And if we break through that, then we've got more support back at 180, After that we've got 160, and then we've got Oblivion after that. That should be interesting. The iPad was definitely not as well received. I don't think it's a bad product, but the stock is definitely overpriced at 34 PE ratio. That's just a ridiculous amount. What else do we have here? Oil. Oil has not yet made a lower low, so oil is still in an uptrend for the time being. Natural gas is um, also still in an uptrend. Gold. Gold has made a lower low and a lower high, so technically we could start, actually not quite a lower low yet, it's at the low. Depending on what it does next, it's not quite yet a downtrend. But it's certainly not the prettiest chart. I should have waited a little while to buy some gold. Then again, I never mind owning gold, the only real money in the world, and silver, of course. Um, but we'll see how that continues. The interesting or the important chart here to look at is actually the gold-silver ratio. Gold-silver ratio um, being at 67, which is definitely a bad sign. 66, 67 is definitely a very bad level. It basically says that people are escaping into safety and people are um, wanting out of silver. Silver is your advanced, it's basically your technology um, metal, where copper is your wiring metal, silver is your semiconductor metal. And so for silver to go so much higher than gold is not a good sign. It doesn't spell very good for the technology sector. The VIX is not as high as I expected it to be. There's a few things that I'm a little bit disappointed on. I am, for example, quite disappointed that, let's go down here, um, that the consumer discretionary has now gone from 30 and a half down to 29. My puts haven't moved at all. I am not happy about that at all. Um, because that's $1.50 drop, so I expected my puts to do something on that. So that's not good. What else do we have? The New York Stock Exchange here is definitely making lower lows, so we'll see how that continues. Crossover, 1030 crossovers are happening everywhere, so those are quite bearish signs, and the environment's very different now from the way it was before. So anyways, that's all I have for today. I hope you keep an eye on the market next week, see what happens. Things are definitely going more in the direction of the bears, but let's see what the bulls will have for next week. They might just pounce back, and yeah. So good luck. Hope you make lots of money, and all the best. Bye.